This painting by a Swedish friend of mine illustrates the American expression, kicking the can down the road. Now, for years and years, central banks, and especially the two biggest ones in the West, which is the Fed, of course, and the ECB, they have been kicking the can of debt down the road for many, many years, until we've got to a point where we are today, when the can is much too big. This can of what we call a soup of debt, soup that is so heavy now that it will not be possible to solve this in an orderly way. You get to a point when money printing becomes worthless, and the money becomes worthless, and this is what we're seeing now with gold reflecting that perfectly. Since 1971, all the currencies are down 99% or more against gold. And we're now moving to the period when the final 1% is also going to disappear as gold. So gold will go up by multiples and paper money will go down to zero and be worthless, as it has been time and time again in history. There's nothing new. It's just the magnitude of the debt is so much greater, and we have to include derivatives in this. And I think, we're talking about debts of 350 trillion or more globally, and we're talking about derivatives of maybe 2 quadrillion if you include all shadow banking and outside the banking system. So you're talking about an amount of debt and a can which is much too big to kick further down the road. So this is why we're going to have a problem in the world now. Central banks will not have the power to save this like they did in 2008. 2008 was a good time at least to let the system fail. Now it's many-fold worse than it was at that point, and therefore the solution cannot come in an orderly way. It will be a disorderly reset of the system, with parts of the banking system not surviving in its present form, paper assets crashing, including obviously stocks, bonds, derivatives, etc. So we're in for a very, very difficult period in the world. Obviously, physical gold reflects what's happening to money, always has, because physical gold is constant purchasing power. And this is what we're going to see this time again, with gold in paper money terms going up by massive percentages. But in real terms, it will at least maintain purchasing power. But I think because of the very big demand we're going to see for gold, and of course that demand cannot be satisfied by making more gold or refining more gold, because there isn't more gold than around 3,000 tons every year to be had from the mines. And therefore, the only way that the increase in demand of gold can be satisfied is by a higher price, not by more quantities of gold. There'll be tremendous pressure on the gold price upwards. And I think the gold price will move, because of this demand we're going to get now in the next few years, is going to move much faster than just by purchasing power. I think there'll be a permanent revaluation that will make people think totally differently about gold. And I think in the future, there won't be just 0.5% of world financial assets in gold. Everybody will consider that you have to have at least 10 or 20% of your assets in gold for wealth preservation purpose. That's what we're going to see in the next few years. And this is, as I said, going to be reflected in the gold price. This is why you have to hold physical gold and some silver outside the banking system and store it in the safest jurisdictions and in the safest vaults where you have direct access.